So what we're going to be doing now is we are going to be going over our short and long position entry model, okay? So what we've got here is the basics behind any sort of entry you want to be taking across all time frames, whether you're looking on the 1 second chart or whether you're using the higher time frames for entry. Everything is fractal, okay? And the same processes that we look for in our entry model is fractal across all time frames, okay? Now, if you've been in other communities before, you might have seen different entry model lists where you see a massive amount of 12 to 15 different entry models where you've got these different inducements and different liquidity sweeps across different things. And all of this can just make things so complicated and confusing. The most important thing we always talk about, okay, is structure. Structure is the most important thing that we look for, okay? Now, what we have here on the left-hand side in the bottom left are the 5 main processes that we look for. And with this, with the incorporation of understanding how to read lower time frame order flow, which is using our supply and demand ranges, which we're going to go over later on, this is what is going to give you an understanding how you want to enter the market, okay? Because the entry model that you're looking for, okay, it's not always going to look the same, okay? It's not going to always look crystal clear like you see in these pictures, okay? But the same 5 processes that we are looking for are the same, okay? Which is if we want to see a mitigation to a higher time frame supply or demand level, okay? So if, for example, we are looking to take a trade off a 15-minute point of interest and we're looking to get involved on the M1, if we're looking to get involved on the M1, have we mitigated into a 15-minute supply or demand level, okay? That is step 1. So have we mitigated into something? Because the most important thing is you must be looking to take your entry when we are inside a supply or demand level, okay? You can't be taking trades out of nowhere. So if you're on the M1 time frame or anywhere on any entry time frame and you are not looking to use that time frame in the correct level, okay, you're going to take losses because we understand we are looking to enter trades in our specific supply and demand levels. So if you're looking to take trades and you're on your entry execution time frame and you are not on or inside the right level that you should be, you're going to take a lot of losses, and we're going to teach you what timeframes to use for what different zones, etc. But you must make sure we mitigate into some form of higher timeframe supply demand level. So if you're trading intraday, trading M15 supply demand levels, are you, for example, using the M1 time frame? Have we mitigated a 15-minute? Same thing if we're using, say, a 4-hour zone, and we are looking to use the 15-minute to confirm. Basically, if we're on the 15-minute, have we tapped into and mitigated the higher time frame level, being the 4-hour, okay? This is always the most important thing. You mustn't drop to your entry execution time frame until you are inside your supply or demand level you're looking to take the trade from. Otherwise, you're going to take a lot of losses, okay? So you always want to make sure that's number 1. Number 2, you need to make sure that in our entry model, we are seeing a liquidation, we're seeing liquidity being taken out of the market. So for example, if we're looking in this case here, we can see we're looking for a short position. What we are seeing is we are seeing a distribution happen where we are seeing price turn from buyers into sellers, okay? So what we're doing is basically what is occurring on the charts at this given point is all the buyers are being taken out of the market and are switching, and all the sellers are starting to come into the market. So we want to see buyers being taken out of the market. So when we're saying we want to see a sweep, the sweep might differ for each one. So we could see an equal highs and lows sweep, we might see a trendline liquidity sweep, or we might just see a highs and lows sweep like we can see here. So you can see here that we've got higher high, higher low, a new higher high, the liquidity above the higher high gets taken. Same thing here. So we can see we have a higher high, we pull back, we understand in bullish market structure, we have an expectation to take the liquidity above the higher high. So as we are coming into our supply level in this case, are we seeing liquidity being taken? So we can see the liquidity above this high has been taken, the liquidity above this high has been taken, okay? So we can see here in this example, we can see that there is liquidity being taken. This could also be in the form of equal highs. So if we had equal highs liquidity and then a sweep, that is perfectly valid. But just think, from all the liquidity stuff we've learned before, it can be in the form of a trend line, it can be in the form of equal highs and lows, and it can also be in the form of highs and lows liquidity. Once we've mitigated into our higher time frame supply demand level and we've had that mitigation, have we seen some form of sweep or liquidation in the market? Are we seeing the retail traders being taken out of the market? That is step number 2. So the third thing we need to look for is interaction. So what an interaction is we've talked about supply and demand flips before, the demand to supply or supply to demand flips. We understand that when we're in a bearish example, we have demand that turns into supply, and it's vice versa. Here we have supply that turns into demand, okay? So what the interaction stage of this is we understand currently here in this bullish market structure, we have higher high, higher low, higher high. The expectation is a new higher low before a new higher high, okay? We understand that that is what we're looking for. But the interaction part is where we see the higher high, the higher low, the higher high, and then the interaction is where we then come and mitigate into our demand level, because we understand that these demand levels, if it's going to fulfill its expectation, should come and put in a new higher high, okay? So the interaction is seeing price react to demand. So we understand if we're looking to take a short position, okay, inside this high time frame supply level, and price has tapped into it, we understand now if price has pulled back and we see a reaction to this demand, if we see this demand fail, okay, this gives us a demand to supply flip, okay? So we want to see that interaction. So what I mean by this is, we're going to go into examples later on, but if we were to draw this on, okay, and we have the higher high, higher low, higher high, and price just breaks straight down, okay, without reacting to any sort of demand. There was no interaction here. So the interaction is where price pulls back down. It reacts to either a supply or demand level and gives us a reaction, which the interaction ends up leading to the flip, okay? So if this, just to say for here, as price came here, if this came down and continued to just smash straight through down here, like so, there would have been no interaction here, okay? Because price has just come up and smashed straight down. It's given us a change of character, but it hasn't given us any sort of interaction. The interaction is the interaction between the buyers and the sellers, or the sellers with the buyers, okay? It's important to see that step, and it's one of the most important things we want to see when we're looking to get involved in the trades. Because if you have a look and just take change of characters, for example, you'll see, just write this down. If you take sort of where you see, because obviously what we're looking for is that shift in order flow, which is the next step. We understand that if we don't see that interaction, these are where a lot of your losses will come in. So really test this, but you want to be seeing this interaction between buyers and sellers. So the interaction step is where price comes back down, reacts to our demand level, okay? We get our reaction, and obviously which then leads to now the change of character and the shift in order flow. So we understand that using our utilization of ranges, okay, we can see here that what have we got as price is pushing up. We can see demand range, we can see it's to sell before the buy. Okay, we then get the new sell before the buy. So we've got demand ranges, and then what happens, instead of putting in a new higher low to a new higher high and giving us a new demand range, what has happened? We've had now a change of character where we can see a high has gone, followed by a low has gone, and we've now gone from a demand range to a supply range, okay, which is the buy before the sell, okay? So now we've had that next step. So we've mitigated higher time frame supply, or in this case, higher time frame demand, okay? It's the same thing in the opposite direction. So if we're looking now at we're looking to take a short, have we mitigated into higher time frame supply? Have we been taking liquidity? Have we been seeing these liquidations and the retail being taken out of the market by the multiple ways we know there is liquidity in the market? Have we then had that sweep? Have we then, instead of putting in a new higher high, have we then had that interaction where price reacts to this demand? Because think about it, what should demand do? This should fulfill its expectation if it's going to fulfill itself and put in a new higher high. But what happens? Price reacts to the demand level. So we've had the interaction, and now what's happened? The next step is price has pushed lower. It's given us our change of character, because you can see a high followed by a low has gone. Okay, and then what has happened? This has then led to a shift in order flow, because we've then gone from demand ranges to then a new, because now we've gone from bullish to bearish order flow. We've now gone and put in supply, demand ranges into supply ranges, okay? So we've seen that order flow shift with the change of character, and then the final thing that gets left is the flip, which is this zone right here, which we can see is where we've taken our trade from, okay? So you can see the whole thing. This is our perfect picture entry model, right? And the thing that I want to talk about with this is because people say, do I play the flip or do I play the extreme? So we talked about the extreme is the highest point at the edge of swing structure. So we understand this being the extreme, okay? Or in this case, this being the extreme, okay? Or do you play the flip, okay? Now for me, I like to play the confirmation of both. You can play a risk entry to both if you want to. So we understand we could put a risk entry here, and we could also put a risk entry here. Or you can wait for price to tap into the zone and then give you, again, lower time frame confirmation, okay? So you can wait for price on a lower time frame. So if this was, we'll go into it later on how to confirm it, but you can then wait for price. If price comes into this and it doesn't give you any sort of entry criteria, then comes up into here, and then you get an entry criteria here, you can then look to get involved short, okay? So there's always, sometimes with entries, not always going to be one clear entry, okay? You can have multiple supply or demand levels for your entry, and this is why it can get a little bit confusing. So if you're trading risk entries, the problem you've got is going to be you're not going to know which zone's going to hold. So if you place 2 risk entries, you could immediately present yourself with losses that you don't really want to take, okay? So should you play the flip or should you play the extreme, okay? And it all depends what you'll see and collate around the data you have around entries. So ideally, if you get interaction to, in this example, interaction to demand, you get the reaction, you can see that we've had some sort of liquidation in the flip as well, and then we now have demand that is turned to supply. Usually you can play the flip is the safe level to play. But what the point and that I'm trying to say is that the flip isn't the zone it has to go off, because think about things from a utilization of ranges, okay? This high, okay, has led to this low, okay? So price is valid to pull back up into here, and even if price breaks above this high and comes and taps into the extreme, this is the difference between people who aren't sure when to remove pending orders, etc. Because when you have an extreme here, price is still valid once it's broken out of the supply range to come and tap all the way back up into here before price continues, okay? So you can play the flip, which is the most ideal situation when you get a clear entry model such as this, okay? Or if you can wait for confirmation, or if this doesn't play, okay, you can, price is still valid to come off the extreme, then you can look for the entry criteria and then look to take it short, okay? So that is what you're looking for. It's that 5-step process. And what we're going to do now is just have a look at it from the longs perspective. You can see here that we've had a mitigation to higher time frame demand right here, okay? This is step number 1, which is that tap into your supply or demand level. Okay, number 2 is that liquidation or sweep. So liquidation is seeing, for example, in this case, because we know we're looking to long, you're seeing the people who are looking to essentially buy the market being taken out of the market. So you can see here the liquidation, you can see people are trying to buy are being taken out of the market, okay? The liquidation of retail traders being taken out of the market, okay? Or it can be in the form of, you know, sort of equal low sweep. So you can see people have been swept and then it goes, okay? But you're looking for that liquidity sweep. The next thing you're looking for is that interaction. So we can see here, we've got bearish market structure, lower low, lower high, lower low, lower high, lower low. The expectation is to see a new lower high before a new lower low in the market. So what happens? We react to supply. We have an expectation to put in a new lower low. But what happens? We've now had that interaction to that supply, okay? So that is the most important thing we want to see, especially around entry criteria. We want to see that interaction. So if price was to go and say we came in, put in a new lower high, lower low, and price came and pulled back up and straight away just gave us a change of character and shifted order flow, and we didn't see any interaction, this is not a good thing to see. We want to see the interaction between the buyers and the sellers, and it leads to a flip, okay? So we can see we have a new lower low, lower high, lower low. Okay, we've had that interaction now, and we understand following bearish market structure, we have an expectation that this should come in and put a new lower low, okay? But what happens? We get the interaction to the supply level, and then what happens? We then get a break. We've had a change of character. So we can see here now, we've taken a low and we've taken a high. Okay, and we've gone from now, it's that shift in order flow, because we can see price has shifted from supply ranges to demand ranges, because you can see now the low to the high. So you can see now this now became a new demand range. And then we start to see now the is started to shift from these supply ranges to demand ranges, and you've had that shift in order flow, okay? And the final thing is the flip, okay? And the flip is the supply or demand level that has formed from the interaction to supply or demand. So in this case, we can see that price reacted to this supply, and instead of pushing down, we understand now that this point here gave us the reaction, and then this demand level here was the point that led to supply to fail. It led to the change of character, it led to the flip, and it led to that shift in order flow. It was from this demand level right here that caused that to fail. It caused supply to fail, and it led to that shift in order flow. So the ideal situation of place you'd want to be looking to trade from is going to be that flip zone, okay, which is off your entry right here. But what you've got to understand is that price doesn't always have to go off the flip. Price can also play, and it's perfectly valid to play off the extreme, because we understand that anything inside this demand range is still valid, because think about it structurally, this is just a range. We've broken out of the range, and this is just the extreme of the range, okay? This is what we call the decisional, which is if you've got two supply or demand levels that you can trade from. The extreme is the one that's at the most extreme point, which is at the edge of structure. And then your decisional is the one that you have, which is basically in front or above it, basically the other one that you have that isn't at the extreme, okay? So again, price is valid to either take from this point right here or this point right here, okay? And how do you get involved in these trades? How do you enter them? So you can either place a risk entry on, if depending how you want to do it. Most people will put a risk entry on the flip. You can also place a risk entry on the extreme, because we understand that one of these two zones are the likely zones that it's going to hold. Ideally, the flip zone is the highest probable level that we'd like to see hold, okay? But if you don't want to place risk entries, which isn't something that I like to do personally, instead of having to place a risk entry, which we understand is placing a order on a supply or demand level before price has tapped into it, what you can do is you can wait for price then to come and tap into this zone, and then you can confirm it on a lower time frame, okay? So for example, if this now, we've just came and tapped into, let's just say a 15-minute supply or demand level, in this case a demand level, okay? And we're now on the M1 time frame, and this has occurred on the M1 time frame, and we have now created two valid demand levels that we can look to trade from. You can wait for price to come and tap back into these levels and look to trade these on the seconds to further confirm the zones. So you can wait for price to come and tap into this zone right here, like so. And if we get on a lower time frame, our entry model occur like so, you can then look to get involved here and take it long, because what we're doing then is we are further confirming the zone again. So it's like a confirmation within a confirmation, okay? And it's the same thing applies down here. So this, what you've got to understand, this 5-step process, no matter what time frame you are using, is how we want to look to get involved in our trades. We want to see a mitigation to higher time frame supply or demand. We want to see sweeps or liquidations of retail traders or people being taken out of the market, i.e. when we're looking to take shorts out, we want to see these retail traders and these people trying to short the market being swept out, i.e. we can see here that we're taking highs, okay? There's liquidity is being taken out of the market, and vice versa here. When price is pushing lower, we can see the liquidity below the lows being taken, or we want to see some sort of sweep. Then we want to see an interaction to supply or demand. So we understand if we're bullish, we want to see that interaction then to demand, or if we're bearish, we want to see that interaction to the supply, okay? And then that interaction leads to a change of character, where we can see here the high followed by the low followed by the high goes in a long example. We can see a high followed by a low go in a bearish example, okay? And then the final thing that we need to see then is the flip, which is essentially then the zone that has been formed from the interaction to supply or demand to supply, okay? So we can see here that this would be the flip zone right here, and this would be the flip zone right here, okay? The flip zone is the higher probable level to play, but we understand when we go into it later using supply or demand ranges, we understand that price is still valid to play off the extreme, because we understand that this is the buy that's led to the sell. So anywhere from either this level here, which is the decisional, or the extreme, is valid to take short. And then we understand that we can either A, place a risk entry on the zone before price has tapped into the zone, or what we can do is wait for price to come and tap into our flip zone or extreme zone, go to a lower time frame, wait for that zone to be further confirmed, and then we can look to get involved that way. And this is our entry model, depending if you are trading the 1 second time frame or whether you're trading the higher time frames. It's the same thing we want to see across all time frames, all entry criteria. Doesn't matter how you are trading, this is what we want to see, okay? So what we're going to do is, as we always do, we're going to take these to the charts and show you examples of loads of entries, of loads of trades, and show you in real life and practical examples, which we think is going to be the most important thing for you to be able to understand and learn this. To the chart. So what we're going to do now is we're going to apply the entry model criteria that we learn, and we're going to apply it to the charts. So most of you know I trade intraday, and what we're going to be doing here is just sticking to one time frame again. We're just going to use the 15-minute time frame. We're going to look at around 15 minute supply and demand levels, and what we're going to do is we're just going to use M1 for execution, the 1 minute time frame, and we'll also drop to a seconds as well. The seconds entry stuff is going to be something that we're really going to go into when we come into understanding lower time frame order flow, but all we want to do is show you the entry model criteria on the charts first and how you want to be looking at it, okay? So we understand now that we've learned that what we're looking for is price. When we're looking for a confirmation entry, is we're looking for price to come and tap into a supply or demand level, and then what we do is we drop to a relevant lower time frame to look for our entry model, to look to get involved in our trade, okay? That is what we're looking for. Okay, so what we're going to do, like I said, we're going to be trading M15 structure, M15 supply and demand levels, and then we're going to drop when we tap into these levels on the 1 minute to find these entry model criteria that we're looking for. And what we're going to do as well and show you, because we've got a couple of examples loaded here already, it's on structure that we've already done, but you're going to be able to see that sometimes when there's advantages and disadvantages to both, okay? So sometimes if you might use the M1, what you've got to understand is that sometimes you might not get your entry. Price might go without you. Price doesn't have to always come and tap you into your trade, okay? And this is where the differences come in how you want to trade, because sometimes you can take a trade and you can execute a position and sometimes it won't tag you in, and you've got to be able to understand that, because price not always come and tap you in. And what we're going to do is show you examples where we get involved in the trade, and also an example where price might go without you, okay? This is just sticking to the M1 for now. We're not going to teach you the sort of lower time frame order flow stuff yet to really understand sort of what's going on and how to truly understand it just yet. We're going to go into that later on in the course, but what we're going to do now is just show you a few entry model criteria that looking at from the previous video that we've done. We're just going to show you it on the chart. So we're going to use a similar structure that we can see. We've got bullish structure at present here. We've got high. We have an expectation for a higher low before a new high. Okay, so it's the same thing that we saw before. We saw now internally we had a shift from supply ranges to demand ranges. We had that internal break of structure, okay, and we've also had a change of character. So we understand now that we've got internal structure and order flow realigned with swing structure. So when price came up into here, what did it leave? It left behind a sell candle before a buy, which we understand is the demand level. So the confirmation entry, we know now when we get to this point here, we want to drop now to a lower time frame. So such as the M1, the 1 minute time frame is the entry model criteria that we use to confirm a 15-minute zone. So when price comes and taps into the 15-minute zone right here, all we're going to be looking for is our entry model criteria, which we understand is a high time frame mitigation, a liquidity sweep, interaction, okay, then we want to see that change of character and order flow, and then we get the flip, okay? So the first thing that we can see here is we had this 15-minute demand level, which we understood, and we come down and we wait for price to come and tap into the zone. So the first thing that we can see here is price has come in now and it's tapped into the higher time frame demand. So we've had step one, okay, which is to understand that we've had a higher time frame mitigation, okay? The next thing now that we're going to look for is some form of liquidity sweep, okay? So we can see here that as price has pushed down, we can see that price has had liquidity below this low and it's been taken when prices ran here. And we also had liquidity below this low, which has been taken, okay? So we can sort of see that liquidity has been taken, and then as prices come back down now, what has happened next, okay? We've had a high time for mitigation, and we can see liquidity from these lows have been taken, okay? So the next step now is interaction, okay? Now we're going to really go into detail on how to truly understand everything, which will make a lot more sense as you see lots of live examples, because what you've got to understand is the charts are never always going to be picture perfect clean, okay? You're never going to see this perfect entry model, and this is why it's so important to truly gain an understanding for what you can see happening, okay? So as we progress through the course, as we go through more live webinars, trade recaps, etc., it'll start to make a lot more sense around entries, and this is where the true understanding will come. But we just want to show you this entry model first, okay? So we understand that we can play the flip, okay, or we can play the extreme, okay? So if we see what we've had here, okay, we've had a mitigation to our high time frame demand now, okay, so we've dropped to our entry criteria time frame, okay. We've had the liquidation of lows. We can see liquidity has been taken on the way down, okay. Now we're looking for that next step, which is interaction, okay. So what I'm looking at here is we want to look now and see, because we can see here that we've had the change of character, okay. We're looking to see some form of interaction here, okay. So we can see here that we had some form of supply level right here, okay. We can see we had some sort of supply level here, because we can see we've got buy to sell wicks, okay. We've had some form of interaction here now, okay, and price has pushed up, okay? But now this is where we're going to go into it now and understand and see, well, what else has happened, okay? You can see price has come up and it's tapped back into the demand level that was created from the flip, okay? So now this you can see is an unmitigated demand level right here, okay? But if we look to the left, okay, it hasn't really interacted to anything within the leg, okay? So this has formed a valid demand level, but this hasn't really had any interaction. So as price has gone on and broken structure now and given us that change of character, there hasn't really been any sort of interaction, okay, a reaction to supply that's led to demand that's caused this change of character. So in this example, okay, this is something to note down. If price goes on and we get a change of character or anything, and price doesn't tend to give us the flip, price can more often than not go from the extreme, which is what we can see has happened right here, because we understand the extreme is like the most edge point of swing structure. Okay, so we can see that we had this unmitigated demand right here, which is an unmitigated wick. We understand an unmitigated wick on a lower time frame is a valid demand level. Okay, so we can see here that where are the two levels that are deemed as valid. Okay, this is perfectly valid, okay, to look for, because it's a sell candle before a buy. Okay, and what you can do is you can see this is a tiny candle, and you can see that has been reacted off, right? Okay, because we understand it's a sell candle before a buy, and you can see we got a reaction to this. Okay, and you can see that we did get, once we tapped into this, we did get a change of character. Okay, so you could say that this here now, once we've tapped into this demand level and we get another change of character, it's perfectly valid, okay, to say we could potentially see price come off sort of this level now, and we could look to trade this. Okay, but this is where the confluences comes in and stacks. Okay, because if we have a look at this demand level, it didn't react to anything to the left. It's just sort of reacted into an imbalance on a 1 minute, so it hasn't really had much interaction into the supply levels on the left. So what we can say here is, okay, it's perfectly valid, this is now, to look for a long, because what's happened here now, price has pulled back down. Okay, we've mitigated into a valid demand level. Okay, and we've had a change of character. We can also see this did have a flip to this supply level right here, this whole level. We can see it did have an interaction, and then it broke. So this now, in theory, is a perfectly valid trade to look to take long. But as we can see, this would have got taken out as a loss. Okay, so as price comes back down now, and we can see it's tapped into this demand level right here, this is your perfect clean as day entry model. Okay, so what can we see here now? We can see as price is pulling back down, we can see the liquidation of lows. We can see lows being taken, lows being taken, lows being taken. So we understand now that we've had now a mitigation into our demand level. Okay, we've seen a liquidation, so we can see here, here's the low and here's the high. Price has come up and it's reacted to the supply level. Okay, so in theory now, what should happen? Price now should come and put in a new lower low if the structural expectation is to fulfill itself. But we've had a reaction to the supply level, and now this has now led to a change of character, which has now left a supply to demand flip. Okay, because what can we see here? Price has come up, it's come back down, it's reacted to the supply level. Okay, and instead of putting in a new lower low, this now has flipped and led to the change of character. So you can see the low is gone, the high is gone. We've gone from a supply range, okay, which is this, so we've now gone into a new demand range. Okay, so we can now drag this across and see now that this is perfectly valid. Okay, so we can see here now that the flip is the level that this is played from. Okay, we can see that. Okay, is this if you see this here, this is the sell candle before the buy. Okay, and that is the part that reacted to the supply, led to the change of character, and led to the flip. Okay, so your perfect entry model criteria would be now to trade off the flip. Okay, so you can understand and see that we're looking for the last sell candle before the buy, which we can refine to this candle right here, and then we want to refine it to the engulf candle, which would be this candle right here, and we just want to include the wick. So your entry now would be on this demand level right here. You can have it on the open, and we just cover the low. Okay, so you can see there we're getting it like a 2.2 pip stop. Okay, and that is your entry model. Okay, you can see we've had liquidations of lows. Okay, so the liquidity's been taken. We've now had a mitigation into a demand level, higher time frame demand level. We've now had price react to supply, so we've had that interaction. We've then had a change of character, because you can see the low is gone, followed by the high is gone, which has led now to have a flip. Okay, so this is a perfect clean entry model. Like, this is as clean as you're going to get it. Okay, but what you've got to understand is that we understand that price doesn't always have to go off the flip. Okay, it can go off anything that's inside of the demand range. Okay, so you can see, because this is the whole sell candle before the buy. Okay, if price is perfectly valid to pull back down to the bottom of the demand range, okay, because it doesn't have to go off the flip, because we understand the structural idea is valid anywhere before the demand range breaks. Okay, so we can see here now that if we look at this, there's not really anything that's happened here. Okay, that's sort of formed a valid demand level. We can see here that this was a sell candle before a buy, so we could say that this is some form of valid demand, but it's not really done much. Again, you've got to understand and stack our confluences. Okay, understand the different things that we're looking at, okay, which is the whole 5-step process. And we understand that when we look at this, it hasn't really done much. It hasn't interacted with anything to the left. Okay, so if we have a look now and see what's happened Like if we see this level here, yes, there's something in this wick down here which is valid, but we can see that price just continued to push up. Okay, there was no interaction, okay? And the part that led to the supply to fail was when we reacted to this supply, we expect to see a new lower low in the market before a new lower high in the market before a new lower low. But this point here was the point of interaction, okay? This is what's led to the flip that's then led to the change of character. So this flip here is the highest probable level. So you can now set a limit order on this level right here to look to take this long, okay? That is your clean as day entry model on the M1, okay? You're not going to get it much cleaner than that, okay? So we'll just go back. So that is a perfect example of a clean M1 entry model. Just think of the 5 things. We're seeing a mitigation into our demand level. We're seeing liquidity being taken, okay? Retail traders being taken out of the market. We've then had interaction to our supply level, okay? And now what's happened? We've had that shift in order flow. We've had the change of character now because we can see the low's gone, followed by the high's gone, which has now led to us leaving behind a flip. So your entry now is on that demand level, okay? So that is your cleanest day entry on the M1. So what we can do now is just go across and have a look at the next example, okay? So we'll just go back up to the higher time frame structure just to understand what we're actually looking at here. So we can see that this entry, okay, was off this internal breaker structure. As we can see, we understand that we're bullish, okay? But now we can see the order flow has realigned bullish as well. So we can see high, 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 low, high, 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 low, and that is the trade we were catching, okay? But now we can see now what happened. We created a new demand range, okay? So now what we can look to do is to trade the next demand range because we can see here that we can drag this across and then it gets validated once we take the high. So now what we can do is look to take another long from another M15 POI, okay? So what we can do now is we could understand the note. We understood this was a valid demand level as well. But now we can see here, if we just clean this up a little bit, just so we can make it a little bit cleaner for now. We'll just hide these just to clean it up a little bit, okay? Once we got this break right here, okay, it created this new demand range, okay? And what we're looking for now is for price to pull back into a demand level before continuation, because understand order flow and structure are realigned, okay? So the next 2 valid areas we can look to trade for are from this, okay? Or from this level right here, okay? We've understood and drew that one off, but we can see price broke through that level, okay? But we can now draw on and understand that this is a valid demand level we can look to take longs from, okay? So what we do now, like we said, so we wait for price now to come and tap into our demand level, and you do not drop to your entry model criteria time frame until you've tapped into your zone. That is the most important thing, because if you just take M1 entries in the middle of nowhere, you have to make sure that you're taking these in the right areas, okay? So if we drop to the M1 now, and we go and have a look and see what's happened here, right? So what we're looking for now is for price again to come and tap into our demand level, okay? And what we're looking for to do now is we are looking again to see the same entry model occur, okay? This is where you'll see now price is a little bit messier, okay? Price is not as clean as the previous example because we understood that what we're looking for is the same 5-step process, which is a mitigation to the higher time frame supply or demand, liquidations of retail traders being taken out of the market. You see the interaction between the buyers and the sellers. We then see the change of character, which leads to the shift in order flow, followed by the flip, okay? Or it can obviously go off the decisional. So same thing applies here, okay? Prices come up, we've created a newly formed demand level, and then once now price has tapped into this zone, we can then drop to our entry time frame. So we can see here as price came and tapped into the zone here, okay, what's price done? Price has come up and then it's come back down, okay? So we can now see that we've had this mitigation, okay? Has there been a liquidation? Have we seen liquidity been taken? Well, you can see here clearly, if we have a look, we've had a massive liquidation here, okay? We can see this trendline liquidity, okay? We've had the 1 touch, 2 touch, 3 touch, people looking to buy it have been taken out. And then on the way down, we can see liquidations of people. Obviously, we understand that there's liquidity above every high and low. So we can see here now, as price is pushing down, liquidity is being taken here, okay? So what's happened? So we can say now we've had a mitigation to our higher time frame demand level in this case, and we've had a liquidation, okay? So what we're looking for now? What we are looking for now is we are looking to find the next step, which is interaction. So we can see here now that this is the low, okay? So the level that we need to break, we need to see that change of character because it's the low gone followed by the high gone, because it's that first indication that we're getting a trend change. So you can see this is the low, we follow it up, and where's the change of character? It's from here. So we understand now that once price has come back down here and pushed up here, we understand that we've gone from, again, a supply range, okay, which was originally up here. Okay, we've gone from a supply range, okay, which is up here, and it's led down. And now what's happened is, if we just draw this on, we understand we had this supply range, okay. But now what's happened, we've now had a supply range, which is now turned, and we've had the first indication of a trend change, which is the change of character, which is now changed to a demand range, being this level right here, okay? So we've now had a change of character, okay, inside of the demand level, okay? But what we want to do is understand that we need to see all 5 steps happen before we look to get involved in the trade, okay? So once we've had the change of character now, we can see that we've created this new demand range, this sell that's led to this high to break here. So we can drag this across now and we can see, okay, what's valid here now. So we understand now that we have an expectation now, because now what's happened? We've now had a new higher high in the market. We're looking for a new higher low before a higher high, because now we've had this internal order flow and structure shift in line with the higher time frame, because we understand that we're bullish, okay? So now what we can do is understand that we're looking now to see this interaction. Where did the buyers and the sellers step in and out of the market? So if we follow price and just have a look and see what price has done here, price has come up, and this here has reacted to, obviously, this was the buy candle, okay, before the sell, but we can refine it to this level right here. Okay, so this now is a valid supply level, okay? We can see we've had an interaction to this zone, okay? Now price has come back down, okay? And it's come back down, okay? Now what we're looking for is, we understand we're looking for 2 valid demand levels, okay, in this case, which is the sell candles before the buy. So now we could denote and see that straight away, we could see that this is a valid demand level right here, which we can see we got a reaction from. Then this level was valid down here as well, okay? And potentially something within that wick. But this is where the interaction part occurs, okay? Because if we have a look and see what happens, prices come back down, okay? Prices come up, and this point here has interacted to these buy to sell wicks, okay? So we can see here that prices come up. There's not really been any interaction on the way up. This is the point that interacted to the supply. So this is the point here that's pushed down and led to this supply to break, okay? So now, and then if we look at this level right here, if we have a look and see this was a valid supply level right here as well, we can see that this has just broken straight through this supply level, okay? So it's not, this wasn't really as strong of an interaction as this one, because we can see this is interacted to buy to sell wicks, whereas this one is just broken straight through here. So this supply level hasn't really flipped as much of anything really compared to this zone right here, because we can clearly see prices come down, okay? It's just pushed straight up, reacted to the supply level, and instead of putting in a new lower low, this has failed. And then what's happened here now is this didn't really flip anything to the left, and then it's just gone on to go and break the demand range. Okay, so when you're looking at this now, you can see this was the supply level that got the reaction, this was the point that pulled down, and then this was the point that led to the initiation to break the range. Okay, you could say this did as well, and we might be able to see something on a lower time frame. But if we're just looking at our entry model, we want to see what is cleanest on this specific time frame, because if we just look in the 5 second, you'd find demand levels here, here, here. You need to look and see which ones make the most sense on your entry model criteria. So we can see here now that this now has had interaction. This one didn't really have any interaction. It's probably interacted something in this wick, okay, but it's not as clear, okay? And then obviously what's happened here now is price has then gone on and broken structure, okay, or broken out of the range. So you can, it's perfectly valid now to say that this, if you want to trade, take both. This is a valid demand level if you wanted to just take that, okay? But then this as well here is the valid demand level, okay? Because you can see it's the sell candle now within this point that's interacted to the left. It's the sell candle before the buy. And what we do is we refine it to this point right here, okay? So you can see now we have this valid demand level, which is a sell before a buy. And these are 2 valid levels to look to trade from. And then what can you see here now? This one broke, this one didn't play through, which is perfectly fine. Okay, that would have been a loss, but if you wanted to set a risk entry on both, then you can do. But this is where I use seconds entries to confirm it, okay, which is again what we're going to go into later on. So it's valid to put an entry on this point right here, and then we've also got this demand level down here. As we see, price comes in, taps into that specific demand level, and price absolutely rockets. Okay, so that's the difference between the two. Okay, so just remember again, you wait for price to come and tap into your higher time frame supply demand level. Okay, price comes in and you drop to your entry model time frame. So for example, we're using 15-minute supply demand levels. You drop in our case to M1. Okay, so what we can see here now, we've had first step, which is high time frame mitigation. Second step, we've seen liquidations, retail traders being taken out of the market. The third step is the interaction. We've had this high time frame interaction here, and we've also had this inside of it, this smaller interaction. So this now has created some form of demand level that's had interaction. It's then gone on to give us a change of character, and we've seen now that we've had that shift from bearish to bullish order flow, and then we can see here now that this was the point that flipped and was the highest probable level that's gone on to break the demand range because of the interactions that have occurred. So then you can just set your limit order on that point right here, and that is your entry model criteria, okay? It's the same thing over and over again you want to see, okay? The last example was a nice, clean, picture-perfect entry, whereas that is a little bit more messy. But you understand that once this is broken right here, we understand that anything inside of this demand range is valid, okay? So this is where people say, oh, is this valid to take or is this valid to take? Understand your ranges. Like I said, we'll go into it deeper later on, but just understand now this was the low, this was the high. This is your whole demand range. So as price is pulling back into here now, this is valid and this is valid, and anything until this low goes and the demand range fails, it's still valid to long anything inside of this demand range. Okay, so we can see here now, this is where you stack your confluences to see which ones hold more weight, which we can see here that we managed to denote that this was the highest probable level, which is what it's come from. Okay, so now what we're going to do is move on to the next example, okay, which is going to be this level right here. Okay, so we'll go to the higher time frame once again, just to be able to understand and see what we've got going on here. So what we can see here now is that we can see that we have, once again, we've had now a breaker structure to the top side right here. We put in a new higher high. This at this point here, sorry, yeah, so this would have been the protected low once we've broken above this point here. And then prices started to pull back down here now. And what can we see? We've had a mitigation. Once again, what we're going to do is just clean this up, just so we can make it a little bit more cleaner. Okay, so we've had this breaker structure here now. We understand that the protected low was this point right here. Okay. This was the protected low that's led to this high. So now what can we see has happened right here? We've had a mitigation to a demand level. Okay, this is a demand level right here. If we were to go to a higher time frame, we'd be able to see that this is a valid demand level. We can see it's a sell before a buy. So we've had now a mitigation, okay, and we're just talking about the structural idea here. And now we can see once we've had that mitigation to this demand level, we've now had a change of character, a shift in order flow, and now we can see this 15-minute order flow is holding and is back realigned with the swing structure, being bullish, as we can see here. Higher high, higher low, higher high. We're now looking for a new higher low before a new higher high. So this is our target, okay? So we can see we've had the mitigation to higher time frame demand, and now we've had a change of character, and we can now see these demand ranges holding, okay? So we can denote and see that at this point here, this was during London Open. This was our most recent demand range. We're now looking for the sell candle before the buy, which originally was this candle right here. But we refine it to the engulfed level, being this one right here. And now what we do is we wait for price to come and tap back into our 15-minute level. And then once it's tapped into our level, we drop to our M1 entry execution time frame. Okay, so the same thing applies here now, and this is just to show you the difference now between that sometimes you might get this flip occur, okay, but this is to show that it won't always go off the flip, and this is why it's important to understand that sometimes you need to stack your confluences, but you've got to understand this is where losses will come in. You can never always be right, and this is why as we go into it, how I confirm things, I will always confirm a 1 minute POI on the seconds. If we just have a look at this now, we can see we identified this 15-minute demand level, and once price has tapped into it here now, what we can do is we can drop to our entry execution time frame, which is the M1. Okay, so what can we see here now? The first step, have we had our higher time frame mitigation? Okay, we can see perfectly we've mitigated into our M15 point of interest. Okay, so the next thing that we're looking for now, have we had some sort of liquidations and retail traders being taken out of the market? Okay, we can see here that we had relative equal lows right here. We can see have been taken out of the market right here. We can see that they've been taken out, liquidations, and we've had an aggressive push down and mitigated into our demand level. So we've had now a mitigation into our higher time frame level, and we've had liquidations. Okay, so the next thing that we're looking for is interaction. Okay, so if we have a look and see what we've got going on here, this whole buy before a sell is a valid supply level. Prices come up, and we've had some form of interaction now to this supply level. Okay, if we look down here, this whole impulsive move up, if we look in this impulsive leg, these demand levels didn't really react to anything in the swing leg. Okay, price then came up, and it's had a messy interaction here, but what's happened here now is we've had an interaction, price has pulled back down, and our price has led to a flip. Okay, so we can see we've had the mitigation and the liquidations. We've then had interaction to a supply level, because we can see we've come up and we've had some form of reaction to this supply level. So we've had interaction. This has then gone on and given us a change of character, because we can see a low followed by a high has gone, and it's now left a flip. Okay, so like we said before, a valid entry to take, okay, is this is your entry. But you can see here now once again that this would have taken you out for a loss, okay? And this is where it's important for you to understand and stack your confluences and learn how you want to get involved in the market, because we can see here now that you've had an M1 entry model criteria happen here, and it's quite a clean one in the sense of compared to the last one. We've had the mitigation, we've had liquidation, we've had interaction, we've had the change of character, and then we've had a flip. But price has broken and not gone off the flip, okay? And what's actually happened, it's come off the extreme levels. That hasn't really done anything, okay? So again, we understand that both the flip and the extreme are both valid levels to take. So it's up to you how you want to trade them, because you can set an order on both the flip and you can also set an entry on the extreme as well. You can place an entry on both. It doesn't matter which one you trade, okay? It's completely down to you, okay? You can be someone like me, and what you can do, again, is this is where the seconds is going to come in. But like I said, we're going to go into this later on to understand it more deeper. But again, it's all fractal. But then once again, all you're doing is, instead of taking a risk entry on these flipping the decisionals, you wait for price to come and tap back into these levels, drop to the second time frame, and look for this exact entry model to occur. Okay, which is exactly what we've got going on right here, which is what this trade was based off right here. We're not going to go into that just yet. But what we're going to do now is just show you here now an example where you might have your entry model criteria occur, okay, but price doesn't go in your intended direction, okay, and doesn't sort of, well, it goes in your intended direction, but it doesn't play off the zone you intended it to go from, which was this flip right here, and it's come off the extreme. But we're showing you now that we're still looking for the same thing to occur: mitigation, liquidation, then seeing the interaction and the change of character, which leads to that shift in order flow, which we can see we go from supply ranges to demand ranges, and then we see the flip. This flip failed and it's come off the extreme, but this is to show you that the market will never always just come off the flip and do what you expect it to do, okay? And then the final one right here now is just to show you that price doesn't always have to go, and you might be left without an entry sometimes using your specific time frame. So we can see here now that this, again, is just a continuation trade, okay? We can see that this was the higher high, higher low, higher high. We can see we created this valid demand level right here. So when price now is tapped into this 15-minute zone, as we wait for price to come and tap in, we then drop to our M1 time frame, okay? And we're looking for the same thing once again, okay? So now what I'm going to do is just draw that one right here, because we're going to go through different things right here quickly. So what we can see here now is that we can see here that this was the 15-minute demand level that we drew on, and it's the same thing once again. We've had a mitigation into high time frame demand, okay? We've had a liquidation of lows. We can see here now that these lows have been taken, okay? We've had the liquidation, we've had the one touch, two touch, an aggressive move into our demand level, okay? So we've now had two steps. We've had the mitigation, and we've also had the sweep of liquidity. So now what we're looking for is the interaction. So when we look at price come all the way up, okay, price is not doing anything. We're looking for an interaction or something, right? And we can see here now price has come up and reacted to this supply level, okay? Price has pulled back down here now, okay, and then it's gone on and led to the change of character. You can see here, if you want to, I was drawing on an aggressive change of character there because I was on the seconds, but you can see here now that this is where the low goes, followed by the high goes, okay? This is the aggressive entry if you were looking to trade the second change of character, okay? But as we can see here now, you've had the mitigation to your higher time frame demand. We've had the low go, followed by the high go, okay? We've had that change of character, and we've interacted to the supply level right here. We can see this unmitigated wick. We've had the reaction to the supply level, and what do we expect? We'd normally expect price to come and put in a new lower low, but we've had the interaction, price has pulled back down, okay, and then led to the flip. So we've had our entry model criteria here. So where is our entry? Okay, we can look and see now, because we can see this is quite a higher time frame level. We can see here now that once we've had that, we can see we have this sell candle before a buy. So this is now a valid demand level to look for. Okay, and we can potentially refine it down to potentially something inside it, like a 1 minute. Okay, so it's not too clean there. Okay, so you could draw this as your refined 2 minute zone. Okay, and your entry would be on the open and cover the low, okay? So that now is your M1 entry model criteria. We can see here now that what have we had? We've had the mitigation, we've had the liquidation, we've had interaction to supply, okay? We've then had a change of character because we can see a low followed by a high has gone, and we've left behind the flip zone, okay? But what's price done in this case? Price has gone without us, okay? And this is what we need to understand and show you, that price will never always go off your specific level all the time. You'll never always get an entry. And this is where understanding sort of how to read order flow is when we know when is it valid to remove your entry and when we can try and look to get involved, remove this entry and try and take another one, okay? So this now, we've tried to show a variety of different ones, clean ones, messier ones, and now also just showing that sometimes you might not get your entry, okay? So this again is that same thing, 15-minute demand level, okay? Liquidations, we've seen retail traders being taken out. We've had an interaction to supply. We've then had a change of character. That's left behind now a flip zone, and you've also got the extreme, which is valid as well, which we understand. You could obviously say this wicks is a valid demand level as well, but we can see here now that price in this instance has just gone without us, okay? And you've got to understand that if this happens, you've done nothing wrong, okay? In this example, you've built your narrative right, you've built everything right to look for a long idea, you've waited for your entry model, but price in this instance didn't want to come back for a re-entry, and that is perfectly valid, and it's perfectly okay for that to happen, okay? You've got to be able to understand that. Just because it doesn't come and tap you in doesn't mean that you've done it wrong. Just sometimes you've got to be able to accept and understand that you might not get your entry, okay? So that is the entry model criteria, just showing it on the charts and just showing it from a different perspective, just using the 1 minute. But this whole idea of the 5 steps, the mitigation into supply and demand, we want to see the liquidation and take liquidity, we want to see interaction, okay, we want to see a change of character, which leads to the shift in order flow, and then we're looking to either take the flip or we're looking to take the decisional, okay? That is our entry model and our fractal entry model across all time frames. Then what we do is we incorporate supply and demand ranges, which we've already learned, to understand how to read that order flow and have a better understanding for what's going to happen next, which is what we're going to go into. So hope that makes sense. What we're going to do now is make our way to the next video.